Welcome to both of you. Kutgun, I'll start with you. What are your expectations?
Yeah, of course. Thanks for having me. And I think first, we expect solid net adds for Disney Plus in the quarter. But more importantly, we'll hear solid commentary about the momentum that management expects going forward, given a fairly robust content slate, continued benefits from the recent market launches that they had last quarter, and the introduction of the upcoming ad-supported tier. And we do expect that parks will continue to exhibit solid attendance and pricing growth based off of what we've heard from peers like Comcast, NBC Universal. And at the parks, I think the messaging will likely be that regardless of the macro pressures that we continue to see, the way that the management has invested in technology and improved the guest experience and monetization, capacity restraint limitations, and the cost structure, we think that the parks are as well positioned heading into a recession as they've ever been. So we're pretty bullish heading into the print.
All right. And that's if you say if we're heading into recession, if we're not, even better. Michael, what do you think has been the biggest drag on the stock? What can they say today to alleviate that, maybe even change your mind, make you more bullish?
Interesting question. I think that there have been two things that have dragged on the stock. One has been the challenge in the streaming industry overall, and the importance to streaming growth for the enthusiasm toward Disney's stock. So Disney started to grow its subscribers more slowly than the street had anticipated. That was then compounded by some streaming headwinds we saw from peers at Netflix in particular. And if you look at the stock, it really traded alongside the sort of emergence of those concerns. The second issue is around the parks, as was just discussed. The parks are undoubtedly an outstanding asset. I think most investors over the long term would want to be invested in the parks, and I don't disagree with that. However, as we've seen in other industries, we had a period coming out of lockdowns where we really had a high level of pent-up demand coming through. You've seen it in digital advertising, and one of our concerns is that you've seen that at the parks, that the levels that you've seen and the financial performance have reflected something of a pent-up demand level versus a new plateau. And we think the street is kind of treating the level that they've been at as being a new level to grow off of. That's probably where we're the most concerned.
Kutgun, I think of Disney, and going back historically, Disney is a lot of different parts, and there always seems to be some sore thumb with Disney. It's ESPN's woes at one time. It's the network's woes, ABC, at another time. Now there are concerns about streaming and the parks and so on and so on. But are we overlooking the value of the sort of transcendent whole of this company that has not only streaming, but they've got content manufacturing. They've got probably the best content library there is. So if they didn't make another movie for 10 years, there's still going to be people who are going to want to watch Disney and stream Disney. Is that one of the reasons this stock has been so restrained this year?
Yeah, I mean, I think Disney, is a conglomerate, and it is a complicated story and complicated model. But at the core of it, it's content and it's storytelling. And I think as management has shifted the focus away from linear towards streaming and to really leverage all the IP that they have between Marvel, between Lucasfilm, between Pixar and Walt Disney's existing properties, I think the streaming story will continue to evolve and grow and likely ultimately garner a growth premium that you don't really get at Netflix. And you clearly see that firing on all cylinders at the parks. And I think, regardless of recessionary fears or not, that'll continue to drive the story probably into, the next decade plus.